Thanks for clicking! Canada's fixed mortgage rates plunged even further downward in January, as lower bond yields, at least up until recently, have put downward pressure on Canadians' cost of borrowing.
Get them to sign on the line which is dotted.
Indeed, following the Bank of Canada's decision on Wednesday to hold on interest rates, announcing that it was now waiting to see how long rates needed to remain elevated, the media and the usual suspects took that to mean that rate cuts are coming to a theater near us soon, with some even arguing that it could be time to jump into the real estate market.
And I am not lying today!
Yet, as we'll see, while fixed mortgage rates are indeed down, the bond market isn't showing any signs that interest rate cuts are coming anytime soon, with yields up 10 basis points since the Bank of Canada made its decision and up 30 basis points since the beginning of the month. And the reason, of course, is the stark reminder that we received this week that Canada's fixed mortgage rates are not tied to the Bank of Canada. Rather, they're controlled, to a massive extent, by the United States. So what I want to do today is go over my best fixed mortgage rates for the month of January, take a look at why bond yields and potentially mortgage rates are rising despite all of the talk of rate cuts, and then discuss what to look for next. Speaking of next, as we'll see today, a lack of liquidity is starting to become more and more important to the 2024 narrative, with even the Canadian media starting to pick up on it 3 weeks later, but picking up on it nonetheless. We will continue to track the liquidity in the system and how that affects mortgage rates and bond yields on this channel throughout the year. Click like and subscribe if you want to get those updates, but for now, let's get into these mortgage rates. Onto the mortgage rates. First up, my best 5-year fixed insured mortgage rate. An insured mortgage rate, if you'll remember, that's where you have less than 20% down, you have a 25-year amortization, you qualify at the greater of the contract rate plus 2% or 5.25, and you pay the mortgage insurance. My best 5-year fixed insured mortgage rate in November was 5.59, which dropped down significantly to 5.24 in December and is now sitting at 5.09. with variable sitting at prime minus 1.05 or 6.15%. So that's a 15 basis point drop since December, a 50 basis point drop since November, and the 5-year fixed insured rate is now close to back where it was in June of 2023 when it was sitting at 4.99. Also, back then, when Royal LePage predicted that despite the rate hikes, the average price in a home in Canada would end off at $821,000 in 2023. As a side note, December's average price ended off at $657,000, down almost $50,000 from the $708,000 that it was when Royal LePage made that prediction.
Brilliant guy.
Next, insurable mortgage rates, which are down significantly as well. An insurable mortgage, if you'll remember, that's where you have that 20% down. You qualify with a 25-year amortization and the greater of the contract rate or 5.25%, and you don't pay the mortgage insurance. My best 5-year fixed insurable rate in November was 5.84, which fell to 5.64 in December and is now sitting at 5.34, with variable sitting at prime minus 0.7 or 6.5%. So that's a 30 basis point drop since December, a 50 basis point drop since November, and again, the 5-year fixed insurable rate is back down to where it was in June of 2023, when it was sitting at 5.34, back when Royal LePage CEO Phil Soper said that we're almost at the point where Canadians who bought at the peak of the market when the average price was $816,000 would be able to sell without taking a loss.
Boy, that's just a straight shooter with upper management written all over him. Ooh.
And finally, my best 5-year fixed uninsurable mortgage rates, which have plunged downward as well. An uninsurable mortgage rate, that's where you have that 20% down. You have a 30-year amortization, or you take money out of your home vis-a-vis a refinance or equity takeout. You qualify at the contract rate plus 2% or 5.25, whichever is higher. And of course, you don't pay the mortgage insurance. My best 5-year fixed uninsurable in November was sitting at 6.34. That fell to 6.14 in December, and then dropped significantly this month down to 5.62, with variable sitting at prime minus 0.15 or 7.05%. So that's a big drop in the uninsurable mortgage rate, down 60 basis points since November. So yeah, 5-year fixed mortgage rates have dropped considerably over the past few months and are now very close to where they were back in June of 2023, when bond yields were very close to where they are right now. As we all remember, after June of 2023, bond yields shot up almost 100 basis points as central banks raised rates, and, more importantly, a deluge of U.S. debt came to the market. Let's recall very briefly that bond prices and yields are inversely related. So, when a bond price drops, its yield rises. With the US issuing so much debt after June of 2023, so many treasury bonds hitting the market, a lot of that debt was hitting that market with few takers. An overabundance of supply without corresponding demand, prices go down and yields go up. Economics 101.
The f is that?
Bond yields did eventually fall between October and November as the US announced it was going to be changing the way it borrowed money, borrowing more short-term money, relieving pressure on the long-term debt markets. But, as we were reminded this week, this was a band-aid solution. As the US held a 5-year auction on the same day that the Bank of Canada made its announcement, and that auction is being called a dud. The United States ultimately had to pay a higher yield on the debt it was issuing on Wednesday than it thought it was going to have to, as investors are growing increasingly more wary about the amount of US debt coming to the market. As such, on Wednesday, US yields popped up following the auction. Canada's yields followed suit on the same day that the media took the Bank of Canada's announcement to indicate that the cost of borrowing is coming down soon. With, I should note, zero mentions from the media about how the bond market was diverging from the Bank of Canada's announcement. Well, the Canadian media didn't mention it, that is. On US Bloomberg, it was noted that the bond market is bracing for record auction sizes coming to the market in the coming months, meaning that over the next 3 months, the US is going to be holding its largest auctions that investors have ever seen. William O'Donnell from Citigroup said that there is absolutely no precedent for the pace and magnitude of these supply increases. Bloomberg, again Bloomberg US, noted that February to April could see the biggest ever 10-year auctions. And, as we discussed earlier and saw when fixed mortgage rates popped up following June, when there is an overabundance of supply, an overabundance of US debt hitting the market without corresponding demand, prices fall, yields go up, and mortgage rates follow suit thereafter. Further, as we've discussed on this channel before, a lot of the current demand for US debt is coming from the Federal Reserve's reverse repo facility. And if we take a look at that facility is draining down very quickly. Down $1 trillion since June, and down almost $300 billion in just the last 2 months alone. If this facility continues to drain, if it drains down to zero, there will be one less buyer of US debt at these auctions, at a time when these auction sizes are set to continually increase, meaning prices go down, yields and mortgage rates go up. Now, voices are emerging in the United States and elsewhere that the Federal Reserve should stop quantitative tightening and start buying up bonds again.
It's the best thing for both of us.
If, and more importantly when, that happens and the Federal Reserve has to stop quantitative tightening and begin buying up bonds again in order to finance a US deficit, that is, in fact, inflationary. And all of this stuff matters a great deal for Canadians. When the Bank of Canada made that announcement on Wednesday that it was shifting its thinking from whether or not rates were high enough to now discussing how long they had to stay there, we should have seen yields drop. But we didn't. We saw yields pop up based on US debt problems. And we saw this throughout 2023, where US debt auctions had an even greater impact on our own bond market, on our own mortgage rates, than a simple rate decision coming from the Bank of Canada. Yet, based on what we saw from the media in article after article after article, the only question is when rates are coming down. Given that the US is set to increase its auction sizes to unprecedented levels over the next few months, and we've seen what those auctions can do to the Canadian bond market, it's not clear that the cost of borrowing for Canadians is coming down as quickly or as inevitably as the media seems to think it is. As we saw on Wednesday and throughout 2023, the future of Canadian mortgage rates, at least fixed rates, depend a lot more on much larger forces, on a great big problem to the south. With that said, all things being equal, I think we will start to see the central banks, the Bank of Canada, the Federal Reserve, and quantitative tightening sooner than many are thinking. We will obviously continue to track the US debt and US bond auctions and their effects on us here in Canada. Click like and subscribe if you want to get those updates, but for now, thanks so much for watching.